Alright, if you're here, you're probably already sensing it. Something big just broke in silver, and it didn't happen slowly. In the last couple of hours, silver ripped through the $121 level in Western markets, and while people were still trying to process that, China quietly lit the match. Shanghai spot is printing near $139, futures just traded around $146, and that's not a typo. That's a 26 plus premium right now as you're watching this. This isn't hype, this just happened. And if you stay with me for a few minutes, I'm going to show you why this move matters, what most people are missing, and how you can spot these stress signals yourself before they go mainstream. Because here's the thing, if you're watching this right now, you're ahead of most of the market. Your job is to understand what's actually happening while everyone else is still scrolling headlines. Now, before I explain what caused this, let me teach you something most investors never really internalize. Markets don't move first because of headlines. They move because of pressure. Price is just the visible release valve. Think of silver like a warehouse system. Paper contracts are the shipping labels. Physical metal is the actual inventory. As long as the labels circulate faster than anyone asks for boxes, everything looks fine. The system hums along. But when too many people show up asking, "Where's my metal?" the illusion breaks. Premiums explode, delivery slows, and price stops behaving politely. That's what you're watching unfold right now. When you see a premium this large between two markets supposedly trading the same asset, you're not seeing speculation. You're seeing scarcity being priced in real time. It's like two thermometers in the same room showing wildly different temperatures. One of them is lying, or at least lagging badly. And that lag is telling you everything you need to know about where this is headed. So what does that tell us? It tells us the paper game is coming under stress. Here's the thing most people don't understand. Western silver pricing is still dominated by paper trading. Futures, ETFs, derivatives, promises to deliver later. That's the game. China doesn't play that game the same way. When Shanghai bids silver higher, it's because physical buyers are competing for real supply. When you see an 18 premium, then watch it spike to $26, that's not traders speculating on sentiment. That's physical demand outstripping available metal and buyers willing to pay up because they actually need delivery. The West trades paper. The East trades metal. And right now, the East is telling you something the West hasn't priced in yet. Now here's what's actually happening under the hood, and this is where it gets important. First, global supply deficits didn't magically fix themselves. Mine output has lagged demand for years. We're talking about a structural shortfall that's been papered over by drawing down inventories, and those inventories have been quietly drained to keep the system functioning. You didn't see headlines about it because it was slow and boring, until it wasn't. Second, industrial demand didn't slow down. Solar, electronics, energy infrastructure, they're still pulling metal out of circulation every single day. That demand is relentless. It's not cyclical, it's structural. And third, investors came back hard. ETF inflows surged, vault inventories dropped, and suddenly refiners like Perth Mint and Metalor started saying the quiet part out loud by halting new orders. That's your confirmation signal. When refiners pause, it's not because demand is weak, it's because supply chains are snapping. So when Chinese buyers step in and bid aggressively, here's the cascade. Physical metal gets pulled east. Western vaults thin out. Paper markets keep trading because they can, they're just shuffling contracts. But delivery risk creeps in. Premiums rise, backwardation shows up, and eventually, price has to reconcile the gap. That's why this isn't just a breakout. It's a decoupling. And here's the part that should make you nervous if you're not paying attention. Paper price can stay wrong longer than you think, right up until it can't. And when it snaps fast. You don't get a memo. You don't get a warning tweet. The market just reprices in hours what should have happened over weeks. Now let me show you what very few people are talking about. The refiner behavior is the canary in the coal mine. When major refineries stop taking orders, they're not doing it for fun. They're doing it because they can't source enough raw material to meet delivery schedules. They're choosing reputation risk over delivery risk. That's massive. It means the tightness isn't just in the retail market or in some corner of the derivatives complex. It's at the source. It's in the physical supply chain itself. And when that happens, premiums don't compress, they expand. Because now you're not just competing with other investors or industrial users. You're competing with time itself. Every day that passes, more metal leaves the system. More contracts come due. More buyers realize the music might stop. If this feels familiar, it should. This is the exact same playbook we've seen before, and I want you to see the pattern. In the late 1970s, silver didn't grind higher politely. It lurched, stalled, consolidated, then exploded once physical supply disappeared and the Hunt brothers started taking delivery. Silver went from under $6 to over $50 in less than 2 years. Same pattern. Physical demand, paper market lagging, sudden repricing. In 2010 and 2011, ETF demand and industrial tightness drove silver from the teens to nearly $50 in under a year. What happened? Investors came back, industrial use was strong, and inventories couldn't keep up. Price had to adjust violently because the paper market kept pretending everything was fine until it wasn't. And more recently, you've seen similar regional premiums appear in energy markets when physical shortages hit while paper prices lagged. Natural gas in Europe, diesel on the East Coast, every time the same story. Physical leads. Paper follows. Premiums telegraph the stress before price explodes. Zoom out and you see the pattern. When inventories drain and physical premiums lead, price eventually follows. Not because of sentiment, not because of hype, because math wins. Supply minus demand equals price. And when supply can't meet demand, price goes up until it can. That's not a theory. That's how markets clear. And right now, silver is clearing in Asia at $26 higher than it's clearing in New York. That spread is information. That spread is telling you the repricing has already started. It just hasn't shown up in the futures market yet. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this reverse? Of course. Margins can rise. Exchanges can intervene. Volatility can shake people out. China could pull back. Industrial users could slow orders. And yes, silver has a long history of frustrating bulls. It's a small market. It's volatile. It can whipsaw you into next week if you're not careful. The market can stay chaotic, political, and messy. Could this be manipulation? Maybe. Could there be forces that don't want silver at $150? Probably. But here's the thing. It doesn't actually matter whether someone's trying to suppress the price or trying to pump it. The mechanics are what matter. And the mechanics right now are showing physical tightness, elevated premiums, and refiner stress. Focus on what you can control. Focus on what you can measure. Spreads, premiums, delivery data, inventory trends. Those are facts. Everything else is narrative. There are probably 3 types of people watching this right now. Maybe you're already in silver and you're wondering if this is the top. You're seeing parabolic candles and thinking, should I take profits? Let me say this clearly. Parabolic moves always feel scary. They're supposed to. That's how momentum works. But structural deficits don't resolve overnight. Your job is risk management, not panic selling. If you bought silver because you believed in the supply story, that story didn't change today. It got validated. So manage your position. Take some off if it helps you sleep. But don't abandon a thesis just because it's working. That's how people miss the big moves. Maybe you're on the sidelines feeling like you missed it. You're watching silver rip and thinking, great, another one I didn't catch. Let me tell you something. You didn't miss the story. You missed the early chapters. And volatility creates opportunity if you stay patient and disciplined. Silver doesn't move in straight lines. It'll pull back. It'll consolidate. It'll give you chances. The question is, will you be ready, or will you wait for confirmation, which is just another word for paying up after everyone else already got in? Start building a watch list. Start tracking those premiums. Start learning how to read delivery data, because the next setup is coming. It always does. Or maybe you're just trying to understand markets better. You're here because you want to learn how this stuff actually works. In that case, this is a masterclass unfolding live. Watch how physical demand leads paper price. Watch how premiums telegraph stress before headlines do. Watch how refiner behavior gives you confirmation before the breakout happens. That lesson applies everywhere. It applies to commodities. It applies to currencies. It applies to any market where paper and physical can diverge. And if you internalize this pattern, you'll spot the next one before most people even know it's starting. So here's what I want you to answer in the comments. Are you watching premiums in other metals? Are you seeing similar patterns in palladium, platinum, even copper? Because if this is starting to spread across the complex, that's not a silver story. That's a monetary story, and that changes everything. Here's where I stand. I'm not chasing candles, and I'm not dismissing this as a fluke. I'm watching 3 things closely. First, I'm watching Chinese and global physical premiums. If they stay elevated or expand further, that's confirmation this isn't a one-day spike. It's a repricing event. If they compress quickly, then maybe this was a squeeze, and we'll see some give back. Second, I'm watching backwardation and delivery volumes. Stress shows up there first. If nearby contracts keep trading above deferred contracts, that's physical tightness. That's people willing to pay more for metal now than metal later. And third, I'm monitoring refiner and vault behavior. When supply players stay defensive, when they're not rushing to flood the market, price risk stays asymmetric. That tells you they don't see relief coming fast. The way I see it, this move was mechanical, not emotional. The fundamentals didn't change today. They got exposed. Supply was already tight. Demand was already strong. Inventories were already drawn down. What changed is the market finally had to acknowledge it. And if history rhymes, silver targeting $130 to $150 isn't crazy. It's a logical next chapter if physical tightness persists, and if those premiums don't collapse. I'm not saying it goes there in a straight line. I'm not saying there won't be pullbacks. I'm saying the setup is there, the pattern is there, and the smart money is paying attention. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the premiums yourself. Look at the refiner statements. Track the inventory data. Don't take my word for it. Take the market's word for it, because the market is screaming right now. And if you're the kind of person who made it this far into this video, you're already thinking differently than most people. That mentality will serve you well. That's how you spot moves early. That's how you position before the headlines. That's how you build real edge in markets that don't give it away for free. If this was valuable, share it with someone who's trying to understand what's happening. Hit subscribe if you want to stay ahead of the next setup, and stay sharp out there. Because the next chapter is already being written, and you're watching it in real time.